The global financial system is often compared to a vast, illuminated skyscraper, where every floor is regulated, every door is locked, and every transaction is recorded under the watchful eyes of central banks. But beneath this structure lies a massive, sprawling basement that remains shrouded in darkness. This is the world of shadow banking, a $63 trillion ecosystem of non-bank financial intermediaries that operate outside the traditional safety nets of the Federal Reserve and the FDIC. While you deposit your paycheck in a regulated bank, the machinery of the global economy is increasingly powered by private equity firms, hedge funds, and special purpose vehicles that move capital across borders with terrifying speed. These entities do not take deposits, yet they provide the credit that fuels real estate markets and corporate expansions. The tension lies in the invisibility of the risk. It is a ghost in the machine. As interest rates climb to combat persistent inflation, the pressure on this unregulated basement is reaching a breaking point. Most citizens remain unaware that their pensions, insurance policies, and even the stability of their local currency are tethered to these opaque structures. The question is no longer if a crack will appear, but whether the foundation of the skyscraper can withstand the weight of a shadow that has grown larger than the light itself. When the liquidity dries up in the hidden corners of the market, the impact is felt not in the boardrooms, but at the kitchen tables of ordinary families who find their world changed overnight. The warnings are no longer theoretical. They're manifesting in the jagged lines of global economic indicators. Across the globe, the signals of a brewing crisis are flashing amber. We see it in the widening spreads of credit default swaps, CDS, which act as an insurance policy against corporate defaults. When the cost of this insurance spikes, it signals that the market is losing faith in the ability of borrowers to pay their debts. In the real estate sector, once stable commercial properties in major American hubs are seeing valuations plummet as the era of cheap money evaporates. As the Federal Reserve maintains elevated interest rates to suppress inflation, the cost of servicing debt has exploded. This creates a liquidity crunch, where even profitable entities find themselves unable to access the cash needed to meet short-term obligations. Historically, such conditions precede systemic shocks. We are witnessing a tightening of the exchange rate for emerging markets, as capital flees toward the perceived safety of the US dollar, leaving local economies hollowed out. In the shadow banking sector, these pressures are amplified because there is no lender of last resort. Unlike commercial banks, these shadow entities cannot turn to the central bank for an emergency loan when investors panic. The signs are there for those who know where to look. A drying up of the repo market, a sudden drop in bond liquidity, and a quiet but desperate accumulation of cash by institutional giants. These are the tremors felt by the financial bedrock before the earthquake strikes, indicating that the leverage built up during a decade of near-zero rates is finally reaching its limit. To understand how a shadow banking crisis transforms into a global catastrophe, one must look at the mechanics of economic shocks. In a traditional system, a bank failure is contained by insurance and regulation. In the shadow system, the primary mechanism of contagion is leverage. These non-bank entities often borrow 10 or 20 times their actual capital to invest in complex financial products. When asset prices begin to fall, whether in real estate or corporate bonds, these entities face a margin call. They are forced to sell their most liquid assets immediately to cover their losses. This forced selling triggers a downward spiral. As they sell, prices drop further, leading to more margin calls and more selling. This is known as a fire sale, and it can freeze the entire global financial plumbing in a matter of hours. This mechanism is further complicated by the interconnectedness of exchange rates and interest rates. As the US dollar strengthens due to rising rates, the debt burden on international entities that borrowed in dollars becomes unbearable. They must sell local currency to buy dollars, causing their own national currencies to collapse. This creates a feedback loop where financial instability in one sector bleeds into the real economy, affecting everything from the price of imported grain to the availability of small business loans. The shadow system acts as a giant amplifier. It takes a small spark in a niche market and turns it into a systemic inferno because there are no circuit breakers to stop the spread. When the flow of credit stops, the heart of the modern economy stops beating, leaving the global population to deal with the cold reality of a paralyzed market. History provides a haunting roadmap of what happens when these shadow mechanisms fail. The 1997 Asian financial crisis remains the premier case study of systemic contagion. It began with the collapse of the Thai baht after a period of unsustainable debt and speculative real estate bubbles fueled by foreign capital. Like a domino effect, the crisis swept through Indonesia and South Korea, eventually forcing the IMF to step in with massive bailouts. But the IMF's bitter medicine of austerity and high interest rates often exacerbated the pain for the working class. In more recent years, Argentina and Turkey have faced similar currency devaluations, where the shadow of dollar-denominated debt looms over every local transaction. In Argentina, hyperinflation became a daily reality, eroding the life savings of millions as the exchange rate spiraled out of control. Greece, during the Eurozone crisis, showed how a debt trap can lead to a decade-long depression when a nation loses its monetary sovereignty. Meanwhile, Venezuela serves as the extreme warning of what happens when institutional trust and economic mechanisms completely dissolve. These cases are not isolated incidents. They are symptoms of a globalized system where debt is the primary product. Whether it is a tequila crisis in Mexico or a taper tantrum in emerging markets, the pattern is identical. A sudden withdrawal of liquidity by the shadow actors leads to a collapse in the standard of living. These global examples prove that no matter how sophisticated a country's finance may seem, they are all vulnerable to the same fundamental laws of credit and confidence. The reach of the shadow banking system is not confined to distant shores. Its impact on the US economy is both profound and perilous. Within the United States, this unregulated sector provides more than half of all credit to households and businesses. When these non-bank lenders face a liquidity crunch, the American dream directly enters the crosshairs. We see this most clearly in the mortgage market, where non-bank lenders now originate the majority of home loans. If these firms lose their funding lines from larger commercial banks, the housing market, the bedrock of American middle-class wealth, can freeze instantly. Furthermore, the US corporate sector is currently carrying record levels of leveraged loans, many of which are packaged into collateralized loan obligations held by shadow entities. As interest rates remain high, the cost of servicing this debt eats into corporate profits, leading to hiring freezes, reduced capital expenditure, and eventually mass layoffs. This isn't just a numbers game for Wall Street. It is a direct threat to the stability of the American workforce. The interconnectedness means that a failure in a hedge fund's derivative position can lead to a tightening of credit for a small business in the Midwest. As liquidity evaporates, the wealth effect reverses, stock portfolios shrink, home equity diminishes, and consumer confidence evaporates. The US economy, which thrives on the fluid movement of capital, becomes stagnant. In this environment, the gap between the financial elite and the average citizen widens, as those with immediate access to cash can weather the storm, while those reliant on credit are left behind in the wreckage of a tightening system. When the shadows begin to lengthen, the burden falls upon the government and the Federal Reserve to act as the ultimate backstop. In the face of a systemic freeze, central banks often resort to quantitative easing or the creation of emergency liquidity facilities to prevent a total shutdown of the repo markets. We saw this during the 2008 crisis, and again in 2020, where the Fed injected trillions of dollars into the financial system to keep the gears of credit turning. However, these interventions come with a heavy price tag. By bailing out the system, the government risks creating moral hazard, where shadow banks continue to take reckless risks, knowing they are too interconnected to fail. Furthermore, these massive injections of liquidity can weaken the currency's purchasing power, leading to the very inflation the Fed is currently trying to fight. Government regulators are now caught in a debt trap. If they raise rates to stop inflation, they break the shadow banking system. If they lower rates to save the system, they ignite hyperinflation. Legislative responses, like the Dodd-Frank Act, attempted to bring more transparency, but much of the risk simply migrated further into the darkness of private credit and offshore entities. Today, central banks are exploring central bank digital currencies as a way to gain more direct control over the flow of money, bypassing the shadow intermediaries. Yet, these measures often feel like a game of cat and mouse. For the average citizen, these high-level policy shifts manifest as fluctuating exchange rates and volatile gas prices, proving that while the government can print money, it cannot always print confidence or stability in a fractured global market. In an era where systemic risks are hidden in the shadows, the concept of financial security must be completely redefined for the individual. Personal survival strategies in a volatile economic landscape begin with the understanding of liquidity. Just as a bank can fail due to a lack of ready cash, a household can collapse if its wealth is locked entirely in illiquid assets like real estate or long-term retirement accounts during a crisis. Financial experts often suggest maintaining a liquidity buffer, cash or near cash equivalents held outside the traditional digital banking grid to navigate periods of bank holidays or credit freezes. Diversification must also move beyond simple stock and bond splits. It now requires hedging against currency devaluation. For those in the US, this might mean looking toward hard assets or commodities that maintain value when the purchasing power of the dollar is eroded by central bank interventions. Furthermore, reducing personal leverage is critical. In a high interest rate environment, debt is a predatory force. High interest credit cards and variable rate loans are the first things that will drain a family's resources when the shadow banking system tightens. Understanding the exchange rate of your own labor is also vital. Investing in skills that are recession-proof and globally transferable provides a level of security that no government bailout can match. The goal is to become an anti-fragile entity, someone who is positioned to not only survive the shocks, but to remain stable while the traditional structures of credit are being rebuilt. Awareness is the first line of defense, allowing you to move your resources before the crowd realizes the exit is narrowing. The most sobering reality of the shadow banking system is its direct impact on the human experience. When we talk about liquidity and leverage, we are ultimately talking about the ability of a parent to afford groceries or a student to pay tuition. In countries like Greece or Turkey, the collapse of credit didn't just stay on trading screens. It moved into the streets. Families found themselves unable to withdraw their own savings from ATMs, and small businesses that had operated for generations closed their doors because they could no longer secure the short-term credit needed to buy inventory. In the United States, the 2008 crisis, a shadow banking event at its core, resulted in millions of foreclosures. People who believed they had built a stable life found that the security of their home was actually a speculative chip in a global game of collateralized debt obligations. This human cost creates a scarring effect on the economy. Young generations, seeing the volatility, become hesitant to invest or start businesses, leading to long-term stagnation. The stress of economic instability also manifests in declining public health, lower birth rates, and increased social friction. When the invisible risks of the shadow system finally become visible, they do so through the erosion of the social contract. The sense of fairness is destroyed when the public realizes that while they must live within their means, the financial architecture is built on a foundation of debt that is never intended to be fully repaid. Understanding these stakes is essential because it reminds us that economics is not just about numbers. It is about the stability of the lives we build for ourselves and our children. As we look toward the future, the global financial landscape is entering a period of profound restructuring. The era of blind globalization and unchecked credit expansion is being replaced by a more fragmented and cautious world. We are seeing the rise of economic nationalism, where countries prioritize the stability of their internal markets over global interconnectedness. For the US dollar, this means facing its most significant challenge since the Bretton Woods Agreement. Nations are increasingly seeking bilateral trade agreements that bypass the dollar, partly to insulate themselves from the risks inherent in the US-dominated shadow banking system. Meanwhile, The integration of artificial intelligence into finance is creating a new digital shadow where algorithms execute trades at speeds that outpace human regulation. This could lead to flash crashes that are deeper and more frequent than anything we have seen before. However, this transition also offers an opportunity for a great reset of financial principles. There is a growing movement toward narrow banking, a system where banks must hold 100% reserves, effectively eliminating the risk of bank runs and the need for shadow intermediaries. While the transition would be painful, it could lead to a future where the financial system serves the real economy rather than the other way around. The insight for the viewer is that the current instability is a symptom of a system in transition. By watching the movements of central bank gold reserves and the development of alternative payment rails, one can see the blueprint of the new world being drawn in real time. We stand at a crossroads in economic history. The shadow banking system, once a useful engine for global growth, has become a labyrinth of risk that threatens to swallow the very prosperity it helped create. But the ultimate lesson of this documentary is not one of despair, but of agency. Knowledge is the only true hedge against systemic collapse. By understanding the mechanics of debt, the fragility of liquidity, and the shifting tides of geopolitics, you move from being a passive victim of the cycle to an informed participant in your own survival. The trillion-dollar risk no one sees is only invisible if we choose not to look. As the light of transparency begins to hit the basement of our global skyscraper, we may find that the structures we thought were permanent are actually in need of a radical redesign. The future belongs to the prepared those who recognize that wealth is not just a number in a digital ledger, but the ability to remain resilient when the shadows fall. The American economy has reinvented itself many times before, and it will do so again. However, the cost of that reinvention will be determined by how quickly we acknowledge the ghosts in our machine. As you look at your own financial horizon, ask yourself, is your foundation built on the solid ground of reality, or is it resting on a shadow? The answer to that question will define your path through the coming storm. In a world of infinite debt, the most valuable asset you can hold is the truth.